Good evening, folks. I request you to please let me know through the chat window if you can hear me properly. Thank you, Aditya sir. It's great to have you all here on our special subscriber webinar. We'll quickly go through a small presentation so that we understand what are the key risks that are hovering in the market today. We'll also look at Kane India once more because I think that in most of the people have quite a lot of query as well as doubt on Kane India. So it's important that we have a look in a much more detailed way for Kane India and see how the risk reward is there for Kane India. So before we start, let's look at the economy first. Starting with the US economy, I would like to use much more on the basis of some cartoons to try and explain where the things are going as far as the US economy goes. Now, post a financial crisis of 2008, 2009, we saw lots of what one may call as unconventional monetary experiment done by the US Fed, starting with QE1, QE2, and QE3. Now, over the last 1 year now, Fed has been trying to kind of cut down its in a quantitative easing. It has been trying to do that by tapering about $10 billion in each of its Fed monetary policy meet. We expect that by October, this October would be the last in which most of the QE that they would be doing would be finished. So now the key risk that one needs to look out for is two things. One, US economy, even though certain parameters show that US economy is recovering, especially Q2 GDP was extremely good at 4%. The unemployment is down about, I think, close to 5.8, but definitely below 6%. Uh, and inflation continues to remain below 2%. So the key guidance that parameters that Fed has been giving to the market till now has been that of inflation below 2%, uh, unemployment below 6% would be the key aspects that they would like to look at before they were to resort to a normalizing of the monetary policy. Now we believe that has happened. However, if one were to read the Fed chairman Janet Yellen's statement very clearly, she is not yet or the panel is not yet confident to believe that there is a resurgence in growth back, or it is in a sustainable way. They still think that the global economy remains in a very weak. They still believe that they would like to see even wage increases to be very sure that the US economy has returned back to its normal growth path, and they would then think of normalizing the interest rates. Now, what I tend to think about US economy is that if one were to look at the kind of Fed increase that the Fed has done on its own balance sheet and the kind of growth that US economy has done, clearly be one may say that I am a bit biased, but it's very clear. It seems clear that another mon unconventional monetary experiment has not worked. Obama has been a disappointment in some aspect because when he came as as a president, he had aimed at reviving the U.S. economy based on US government making expenses or investments, especially in cases like infrastructure or education. That has not happened. He has rather for him to do that, he would have needed quite a lot of bipartisan support. But in pursuit of his some pet policies, that bipartisan support has been lost, and in the process, lots of key economic reforms have not taken place. Uh, just yesterday, I think IMF chief Christine Lagarde had just said that if US were to just go back to its reform path, she would be willing to do a belly dance for all the senators and congressmen. My point being that the key thing that is needed in US is not monetary policy reform, but it is more tax policy reforms, more fiscal reform, and more investments happening in certain core sectors. If you were to look for quite a long time, US has not been investing as much it should have done in creating a strong infrastructure for the 21st century. It compared to its peers, the which have been moving in a much more faster direction, and this is like Australia or like other countries like Germany. Now, if that be the case, it would be very hard for US to keep a competition from other countries, especially China. The only thing that it may help is US to sustain as the world's largest economy in real in nominal terms would be largely be enough the way the Chinese economy is behaving now. Before we go to China, I would like to go to Europe a bit. Now, the key problem that has been facing Europe has been largely been the deflationary pressures. As you can see in the graph on the left-hand side corner, top corner, you will see that a large section of the European economy is suffering from a price deflation. I presume price deflation is the major problem that is on the minds of most of the people. This is also a side effect of a very high level of unemployment, very low level of growth in many of the countries that are in red, except with the exception of Netherlands. But if you look at on the southern side, the problem still continues. Rather, if we were paying attention to what has been the data reported coming out from Germany and France over the last 15 days, the data have been very disappointing, and it points that the slowdown is been moving to Germany also. There is a case of saying that one of the reasons for slowdown in Germany is also as a result of the sanctions in place with respect to Russia. This, I believe, is one of the could be attributed as a major reason, but a slowdown in Germany was visible quite before and as the sanctions in with Russia started to take effect. So slowdown in Germany is not just related with the sanctions in Russia, it is also related with respect to the slowdown in export that the Germany used to do to much of its European cousins. Now that is not happening. So one of the big speculation that has been happening in the global financial markets is that eventually Draghi would have to resort to some sort of quantitative easing. If you would remember, about 2 years back, when Europe was again facing a pressure, especially because of the increased high level of interest rates in G6 of Spain, Italy, Portugal, and especially Greece. At that time, Draghi had effectively just threatened the market that he would come up with a huge quantitative easing program, but he had not actually executed it. It was just a threat of saying that if the interest rates do not connect, then some kind of unconventional monetary easing would be also implemented by ECB, but they had not gone through it. However, we believe that the deflation pressure would be a very really scary for the modern monetary policy leaders, and they would really look at this as a reason sufficient enough to go ahead with the quantitative easing within Europe. Now, third, China, if you one were to look at much of the last decade before 2009, was one of the most high growth economies in the emerging market. Uh, Somewhere around 2009 2008, even its story was built that China may probably be moving towards decoupling itself from the global from the problems of its global economy as it shifts itself from an export oriented to more consumption oriented boom. One of the key things that I have been maintaining for quite a long time is that China does not has a consumption problem, it has a more of an investment problem. The percentage of investment that it has been doing as percentage of GDP that it has been doing has been tremendously very high. At many cases now, we believe that there are many projects in China that would not generate any economic returns, meaning that the incremental benefit that the GDP can get because of pure investments happening either in real estate, creation of new infrastructure, would not be that high as it was in the past. Second, China also started with a new policy of a free trade zones. This is something new from what it has traditionally had as an SEZ. But over last 3 4 years, what we have seen is that the investment in this first free trade zone has been very low. It has the kind of promises that have been made on the currency convertibility, on taxation, and on the labor flexibility. Those kind of policy changes have materialized even for this free trade zone, and most of the people have just made a notional investment in this free trade zone. So the big reform that was planned by the Chinese new leadership, that has not yet taken place. There not sounding a bit conspiratorial, but typically there is a tendency that if you tend to see a communist or a highly dictatorial oriented leadership, or as one may call as technocracy oriented leadership in China, moving towards more belligerence and more in pursuit of more show of strength of its power across its neighborhood, one need to be at the same time be worried that this may be also a case of Chinese leadership trying to divert the attention of Chinese population towards this kind of through this kind of belligerence from away from the economy. We have seen this kind of behavior during the Cold Wars, when the time when we saw Russian economy, USSR not doing well at that time, and the communist leadership had targeted and tried to do something of this kind in order to divert the attention of the Soviet population. If one must consider if that is happening in China too. It may be a bit of an extreme case, but if the Chinese economy is slowing down at a faster rate, China may be indulging itself in a show of strength kind of scenario. On the other hand, the big thing that worries me about China is, as a recent article in Wall Street Journal started pointing out, was the increased level of debt, non-performing assets in the Chinese banks, and especially in the shadow banking and system of China. Now, this is a very big aspect for China, because one of the big reasons that Chinese GDP has grown over last 20 years has been, as I have stated, investment. And for an investment-led boom, you need to have the banks to have the ability and profitability of financing and those investments. If there is increased NPA levels, one may be reasonable in expecting that we would see banks going forward being very reluctant in investing in many of the projects that are there in China, resulting in a bit of a slowdown of consumption as well as investment happening in China and impacting the GDP as such. Now, moving towards India. Uh, After the May 22nd, I believe, I would rather say from, the state elections of December, the markets have been taken over by Modi hype. And now I would like to make a disclosure. I am a supporter of BJP, and with that an extension supporter of Modi. But however, having said that, one of the key things that we need to understand is that the problems of the Indian economy are not something that can be solved by a single person. It would need an impactful decision-making process, and wherein there is a participation from both the central leadership and the state leadership, as well as by the industries across India. Second, I would like to say that when we look at now what kind of impact he had done in Gujarat, and then we try to extrapolate the same thing in center, we misunderstand the complexity of problems of the nation as a whole compared to a state taken singularly. Modi significantly, yes, represents a clear change and shift in leadership, but however, to expect it as the market has been expecting over the last 6 7 months, that the change would be visible immediately, and he would go towards a tough reform. I believe that is a bit of over expectation from our side, and nothing signifies it's as good as the Swachh Bharat Abhiyan launched by the Prime Minister. Now, it's a very good experiment started by the Prime Minister, but however, if one were to look at the kind of experiment it is, we should, if we expect that this would happen as a result of proactiveness by the government departments, whether at the municipal or state or at central level, then we are clearly misplaced. I just read an article about 1 or 2 days back, wherein Aam Aadmi Party submitted about 2,500 photographs of an garbage around the city of Delhi. One of the photographs strikes me very clearly in that there was a dustbin which was clearly empty, and most of the people were throwing the garbage outside of the dustbin. Now this is the case that I want to point. This is not something that would have can be solved easily by just Delhi Municipal Corporation. There they would need the cooperation of citizens also to have some civic sense to keep the nation as well as their streets clean. My point being, much of the program that Modi would launch, he would need an cooperation from most of the part of the society, whether it is in investment, whether it is in education, whether it is in cleanliness. Now most of these programs would take about 2 or 3 years to just reach a certain stage within which they can be they can create a kind of a foundation which would help him launch much more radical reforms. I believe one needs to have that kind of waiting period without getting depressed that another earning growth is not happening for the companies, or the revenue growth is not happening for the companies as expected at the end of the election. I think one needs to give the Prime Minister and his team a time of about at least 24 to 36 months before we start expecting any sort of returns. If one were to look at just fiscal deficit side, if the oil prices would not have corrected, and in that India has has been seriously been very lucky in that, then we would have been very hard pressed to expect a 4.1% of a fiscal GDP, a fiscal deficit target, and by the end of this financial year. However, now that the oil has corrected and it seems that it may still keep on falling for some time, we can expect that the fiscal deficit can of target of 4.1 should be easily achieved. Now moving, speaking about oil, one of the key, yeah, I just want to go back to India for a second. Now the key risks, the inflation in India continues to be very high, and controlling inflation is the key towards getting more investment happening in India. One of the reasons, one of the part that and most people forget is that if the inflation continues to be very high, then it strokes its own negative and a vicious cycle. If the inflations are high, employees will demand much more higher salaries, but even though they get more salaries, they would not have much more higher disposable income. The consumption would be very less. The consumption is very less. The businessman would not find much more demand, a very high increase in demand sufficient enough for them to start thinking about investment, doing more capital investment in the economy. If the capital investment in the economy does not pick up, again the employment is going to hit. If the employment is going to hit, it is going to impact other aspects of the economy, putting in question mark whether it is feasible for companies to give a much more higher increase in salaries to the employees. So this, in order to break this vicious cycle, it is important for the RBI to control the inflation. Now, personally speaking, I believe that Dr. Raghuram Rajan policy of keeping interest rates at a flat level and not resorting to an increase at least once over the last 12 months is a bit risky strategy, because while it is I understand it pains most of the companies who have very stressed balance sheet, but this pain is needed in order to bring the inflation expectations down. Let's see, as per the recent monetary policy meeting, their expectation is of hopefully hitting a 6% CPI target by Jan of 2016, which means that even RBI as of now believes that if it is going to have a 6% CPI by Jan 2016, which means that for over the next 12 to 18 months, we should be bit lucky to see even a 50 basis point cut. If the economy does, if the fiscal deficit does come down, I think then we can also expect inflation also to start coming down, and we may expect at least one cut in between the next 18 months. But this has to come with lots of things happening positively on many fronts. Oil coming down significantly more, fiscal deficit being managed more prudently, railway also starting to show bit of a profit, and then we can see inflation also starting to come down, which would help and have a bit of an more give more lever more room for RBI to think about interest rate cut. But significant cut I'm not expecting to happen in the year 2000 calendar year 2015. I believe a maximum of 50 basis point is a reasonable expectation. More aggressive cuts may happen in the 2016 once I believe consumer price inflation has started to come closer to 5%, lesser than 6%, and much more closer to 5%. Now, speaking as I was speaking about oil, when I look at and I will explain about my expectations about oil because of through Cane India itself. When I look at the markets, I see much of the market has a huge fear about investing in the Cane India. I'm assuming they have huge fear given the way the stock has reacted from coming down from 360 to 280 kind of levels. Most of the investors who have bought stock are at around say 350 who are our clients, and they thought that they have made a mistake. They are clearly exploding their brains. They believe that they may have made some mistake. And if you think of how I am looking at Cane India, I am clearly salivating about how I look at Cane India. Now there is a reason why I am salivating at looking at Cane India at 280 price, and I want to do a very foolish kind of an experiment or analysis of Cane India in just in front of you. uh, I do believe that you guys need an explanation, and I believe that my explanation now would help you in understanding how I look at Cane India on a very uh, extreme conservatism, extreme deep value basis, and that would help us understand what is the kind of risk reward scenario that exists in Cane India. So let's take a case one. In this case, I'm just showing one factor to you, which has been used to make a basic valuation case for Cane India. Now, there are few things that I am doing in this case. I am not assuming that Cane India is going to sustain its business beyond 2020, because the reason to assume that is its biggest oil field, that is in Rajasthan, is its lease is expiring in 2020. As of now, government has not given it an extension. Typically, an extension of 5 years should be given for an oil field and 10 years for a gas field. But that has generally has happened. Cane India has made a presentation to the oil and gas ministry in the month of August. July or August, and the decision is still awaited as to whether they get an extension or not. Now, this case I'm doing it on three basic levels, and each of the three level I'm not assuming that they are getting any extension. Now, in the case one of the things that I'm assuming is that they are not going to grow their oil output. Their current oil output stand at 2.17 lakh barrel per day, and I am clearly assuming that their oil output is not going to increase. And in order to maintain even this oil output, they would have to expend at least 2000 crores each year as a maintenance capex. Meant by maintenance capex, I mean that they would have to continue to invest into certain capital goods so that they can keep on extracting that level of oil each year. And if I to do that way, then I still get a cash flow that is of this kind, that is somewhat closer to 7,002 and this kind. The last year of 3,400, it is less because we are assuming that after 2020 it would lose lease on an oil and on its an asset in Rajasthan, so it would also have to expend some amount of money as a restoration money. That is about, I'm assuming in the base case of about 4,000 crore that it will have to expend in the last year. This is when over an additional amount of money that it will have to do in the year 2020. Now, assuming just this kind of cash flow, this is the kind of valuation that I tend to get for just for the cash flow it can generate at a 10%. I am taking a very, I do accept that the 10% is a very low level, but we need to accept that this is one of the worst kind of a valuation that I am trying to do over here. Even if you look at the realized price, typically Cane India has been generating about $10 less than whatever is the Brent crude price. So I'm assuming that this year they are just going to get a realized price of $80. They got last year about 92. I'm assuming this year they will just get $80. And over the next 4 years they would get from 2016 to 2020 they'll just get $70. And I tend to get a valuation for their cash flow of 28,000. They already have a cash flow from their Q1 statement of about 19,000 crores, giving me a share price of just 251 rupees. Now let's look at case 2. In case 2, I'm saying that they would, let's say, grow their cash. The management would think, yeah, last option, let's increase our oil output. And again, 7% is the number I've arrived through management guidance only. They lower rate of growth, that guidance that they have given over the next 3 years, which I've extrapolated for the additional 2, is about 7%. So it will grow its an output from 2.17 to 3.25. Again, basic assumption remains the same, that $80 would be there for the first year and $70 for the next 4 years, from 2016 to 20. However, because they are expecting a growth, I'm increasing the capex. In the last slide, you saw that I was doing just a capex of 2,000 crore to just maintain its oil production. I believe if they want to grow at 7%, I believe they would have to do some additional capex. And I believe about 12,000 crores, that roughly translates to about $2 billion over the next 3 years, should be sufficient to give it a flip. And then again, in order to maintain that kind of a growth, they will have to do a 2,000 crore odd of an maintenance capex for the last 2 years. Remember, in 2020 he is also going to relinquish, so we should not expect that he should be doing a very large capex in the last year, because clearly he would not be the beneficiary. The next big point you need to understand is, because he is doing a more higher growth, the restoration expense is also significantly higher. I think bumped it up by about another 2,000 crores, and that results in the fact that my cash flow of just value, pure cash flows present value, comes to 34,000. Because I'm been more optimistic, I have increased the discounting factor to 11%, which uh, is a bit more. I just want to be more conservative. Again, it has a cash of 19,000, so it gives me a share price of close to 285. uh, 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 Please do let me know if you have any doubt through the chat window, so that I'll be more detailed or more say more simpler in my explanation of Kane India. Now, when I look at case 3, in the case 3, 10% growth rate is the major change. Capex, because they want a much more higher growth, I have given them a much more higher capex. And because they are also growing their gas output at 10% level, I'm also increasing their restoration expense to another 2,000 odd crores. And one of the key reasons why, even though the company grows at a higher level, but if you see its implied share price is less, is because it has to do more capex, and there will be significantly more a restoration expense in the last year, which as a result there is a small hit in compared to a case 2. The key point that I wanted to make over here, and which I would explain through my last slide, is I wanted to understand that if I were to take one of the most riskiest, most negative assumptions, that all the that is, I incorporate all the rumors, negative rumors that have been surrounding in this on this company. What is the kind of downside that I'm looking at? So what are the kind of mistakes I've made in this case? These are mistakes that I call foolish mistakes. One, I'm clearly assuming that they are not going to get an extension. This is clearly foolish mistakes from on my part, because till now it has not happened that the companies who are in the production of oil and gas, they have not got an extension. But let's say I've assumed, as just been a conservative, and looking at what is making analysts panic, that I'm looking at that, yeah, they would not get an extension, let's say, even though every company has got up to 5 years if they are producing oil, and 10 years if they are producing gas. Now, second foolish mistake that I am making over here is that we need to clearly accept one thing: Kane India was a plain lucky company. Because if you look at any other company, you see that most of the companies in oil and gas space in India have not done well. Only Kane India has done. So we are clearly incorporating this and saying that Kane India was lucky. It was not because its management was really good in understanding how to run an oil and exploration business. So that is the second foolish mistake we are doing in this thing. Third foolish mistake that we are doing, assuming, is that with such a strong cash flow and such a strong exploration culture across Kane India, as well as across all Vedanta group. So if I were to look at Vedanta group, whether it was Hindustan Zinc, whether it was Balco, whether it was Sesagoa, whether it was copper mines at Konkola, the whole of Vedanta group, if you were to look at one thing that they have done consistently, is that they have tended to increase their resource reserve ratio by 150 percentage each year. Meaning, if they are consuming a resource of, let's say, 1 billion ton, then they would like to add 1.5 billion tons of reserves to their mining. That is one thing that they have done. But we foolishly believe that the Cane India would be not be, which itself also has a strong exploration culture, would do anything about it. It would just sit on the situation that it is not getting an extension. The fourth foolish mistake that we are doing is that we are assuming that oil prices will go down because of China's slowdown, and on the same side we are assuming that other suppliers will not cut down production because the oil prices are going down. Somehow we have forgotten the biggest cartel in this business, that is OPEC. We are believing clearly that the OPEC will not try and manage the expectations of the market in order to protect its own social schemes, its own social welfare benefit schemes in its countries, and its own earnings. So that is the fourth foolish mistake I think I have done. And the fifth foolish mistake is, as I said, that we believe that management will not spend on any capex at some other site, like in spite of the fact that we know that it has a very large asset base in South Africa, and which has very good geological structure, and some for which nearly 80% of the 3D and geological study has been done. Now, key thing to understand over here is that we are also not looking at whether there is can be a gas output, even though the gas reserves are that Cane India has now been reporting over last 3 months has been clearly very equivalent to what Reliance is reporting for KG-D6 as of now, that it is about 3 TCF. Now, these are the kind of foolish mistakes that we have done. Now, there are certain intelligent upsides to this also. We are not considering in this any potential of an exploration benefit recurring coming out, especially from South Africa's Orange Basin. Even though if one were to look at geological structure, it is quite similar to the way geological structure is for KG-D6. So, and one should expect a strong expectation of gas over there, probably not so much for oil. Second, Cane has requested for an extension of 10 years. As I said at the start, that typically oil companies have, as a policy, have got 5-year extensions, and gas companies have got 10-year extensions. But key over here, because of which Cane India has got is asking for a 10-year extension, is because, and one must remember that they are also now producing gas from its Rajasthan asset, which they clearly want to double. So they have a good case to make to the ministry of asking for a 10-year extension. And third, I have not incorporated is Anil Agrawal in many of his interviews when he has been asked about what is his plan for Cane India. He has been clearly stating that he would like to ramp up Cane India's production to 3 lakh barrels per day, and then over some more years he would like to move towards 5 lakh barrels per day. That also we have not incorporated it. And whenever I get this kind of downfall in Cane's price that comes towards my any of my most pessimistic cases, either case 1 of 250 or case 2 of around 280s, case 2 and case 3 of around 280, I clearly become very thankful for the market for rewarding my foolish assumptions, my and giving me very strong upside possible if any one of this 8 cases starts kicking it. The 5 foolish mistakes that I have done, and the 3 intelligent upsides that I can think it. And now you understand why I do not worry about Cane India over the longer term. Yes, in a short term, I may worry on a psychological basis for a simple reason, because if I have bought at 300, I thought I could have bought more at 280 if I would have just waited. But my point is, we at Moneybooks, for me, do not have the capability, neither the capacity to give you a short-term 1 month, 2 month kind of a view. And if one were to look at it, at 15 to 20% fluctuation is something that an investor will have to clearly accept while investing into a investment worthy company over a longer term, because this kind of unpredictability that comes into the market because of what the market has been assuming over the short term cannot be forecasted by any person. Now, one of the key reasons why market has been falling down on Cane India has been as I stated that as is because of the fact that oil prices have been falling. But even if you look at all our cases that I've shown, in most of the cases we are assuming a worst case scenario of 80 and $70 kind of a scenario, and market even though I believe that this is something that can happen, but has a very 40 percentage kind of a probability kind of a scenario. And the reason we have been looking at $80 as a price point of for crude for quite a long time has been because of the fact that we believe clearly that the US economy is going to become hugely surplus in energy, both through natural gas as well as oil. To such an extent, it has already started showing its first effects. There are lots of coal mines that have been shut down for a simple reason that its major consumer, that is power producing coal based power plants, they are shifting to natural gas based and systems for boiling and steam, for generating steam and running their turbines. Now while a surplus level of energy in US is definitely going to revolutionize the manufacturing industry in US, but beyond a point, in order to keep on generating a high quality of investment in the oil and gas sector, especially in the shale oil and shale gas sector, eventually US will have to look at repealing its law which prevent the explorers and oil and producers from exporting energy to any other country other than Canada. I believe that an Obama administration, before it is out, would end up giving at least 3 to 4 LNG licenses for exporting liquefied natural gas to other countries. And this is going to be a significant tectonic and a shift in the oil market that would significantly tend to increase the supply and help both Chinese growth and Indian growth. That as a result of which I do not expect $100 kind of a scenario. I do expect that a $80 kind of a scenario till 2022 should be possible. Post 2022, I expect oil supply from US to again start tapering down. That should help for a higher level of oil prices in post 2022. So my expectation on the oil prices have already factored in what market is already factoring in as of now. And in that, when I don't give a growth rate to Kane India, in that when I don't give it a ramp beyond 2020, meaning that it will not have any kind of a business post 2020, at that point itself I'm getting a valuation close to 250 to 285, showing that the downside is very limited for me as far as Kane India is concerned on a fundamental basis. And that's why if I can get it at 285 kind of a value, which I think today's closing should be close to 288, so it's as close to my case 2 as I can get, assuming just a 7% growth, but certainly the production stopping at the end of 2020. So if that is the kind of growth I can look at, then I am still a very happy investor as such. With this, we'd like to go to each of your questions. uh, if you have any further query on Kane India, do let us know. I will be happy to take it for you. The first question is by Mr. Umakant Bhatt. His question is, for the next 1 year, which sector is expected to outperform and which sector might underperform? Uh, I think one of the keys, we do not tend to look on sector basis. We tend to look on more on company basis. However, looking at how the cluster is towards which sector, which cluster towards which most of these companies are, I believe pharma should continue to outperform in spite of some of the companies getting problems on the FDA side. I believe that most of the pharma companies have strong drug flows, so they should continue to do extremely well as such. On the underperform side, I believe the steel should be one, and steel and aluminum should be one of the places that may underperform for next 1 year. However, I would like to add a caveat over this. To some extent, I'm a bit confused on the aluminum side. The confusion relates to the fact that if you would look at the super commodity bull cycle that has been there because of Chinese growth from 2002 to 2012, then clearly one of the commodities that didn't participate was aluminum. It didn't participate. The aluminum prices did not increase significantly over the last 10-15 years. Now the reason for confusion is that Ford recently launched a vehicle called as Ford 150. You might like to look at it on the net. Now, it is a significantly revolutionary in a sense of design as well as the way it is using and materials. For the first time, the amount of aluminum has been significantly increased in Ford 150 pickup, which in its previous avatar was one of the most phenomenal pickup trucks coming out from Ford stable and very successful in US market. Now I would like to see whether how a Ford pickup with such a high level of aluminum content is received by the market over a period of 1 year. I would like to see if this would result in more companies shifting towards using aluminum as an major component of its auto manufacturing, or and it would continue to prefer to use steel for it. Now, using aluminum has multiple effects in auto sector. Even if you use body of an aluminum instead of steel as it has been used, even the steel shock-ups that you have to use, they can be decreased in weight. So the point is that using more aluminum at many places, decreasing weight, has a multiple level of benefits to the automobile companies across the world. It helps all them also to meet the kind of aggressive and mileage guidance that have been coming out in developed world. Uh, so I would like to see whether there will be issue on the safety, whether the adoption rate will be high, because clearly aluminum cannot be welded. You have to go through a completely different manufacturing processes through if you want to build a Ford, if you want to build an aluminum based vehicle, that would really tend to a big shift in the way manufacturing for auto components is done. It would create its own opportunities for investment. So on the aluminum side, I am a bit confused, but I would like to see how the Ford 150 does in the market post December 2014, and I think that I would get a much better hang how the aluminum does well. However, one need to understand that the promise of aluminum being the new metal has been there for about last 20 years. However, we have seen that in spite of oversupply in the market, most of the big companies have continued to invest into creating new facilities, as a result of which the supply has always been outstripping the demand, and that has been one reason why the aluminum prices have not done well, even though at the price of about 1800 US dollar per ton that an aluminum was quoting, nearly 50% of the companies across the world were making losses at the GP level itself, that is gross profit level itself. So on the aluminum side, I am a bit of a confused. On the steel side, I am long term very positive, but on a short term, I am a bit negative given Chinese slowdown and expectation that the Chinese slowdown will mean that the global steel prices may also fall for a certain point of time. But what most people do not realize is that the fall in prices would also force many Chinese steel makers to shut their shops within a period of 12 to 18 months, and that period would be a great time to invest into steel companies. Though if market do realize it a bit early, you may see a bit more higher valuation in steel place. So I believe in metal, steel and aluminum may continue to underperform. A bit of confusion to me for aluminum. I would once I get a clarity on it, I'll get back to you on this. uh, on the steel side, a good negative downturn is coming that would not be sustainable beyond 12 to 18 months. So that would be a good period to buy into strong aluminum companies. Avoid companies that may have any crappy balance sheets. Avoid companies that may have any corporate governance kind of a issue. The next question is by Mr. George Abraham. His question is a bit similar. He would like to know which sectors and stock will outperform the Nifty index during the next 6 to 12 months. George, I cannot help you with the 6 month scenario. 12-month scenario, I believe I have already answered. Another sector that you may look at, but be careful because the valuations are already steep over there. Cement is a good sector to look at, but valuations tend to be very steep over there. Second, you may also tend to look at an auto ancillaries, even though be careful about what kind of valuations you are getting over there. The next question is by Aditya Save. His question is crude prices are headed south. Which companies will be most affected by this now? How does this create opportunity to buy? Crude prices are clearly headed south. One of the few things that most retail investors do not clearly understand is that some of the companies that get benefited because of crude prices going down are some exploration companies like ONGC. Some like ONGC. Again, GAIL also, even though he does not deals in oil, he gets benefit if the crude prices come down. For one significant reason, because his subsidiary burden also comes down. Clearly, oil marketing companies are also someone who are going to get benefited out of that. But the key point to understand that is the fact that oil is going to correct to at least I believe 87 kind of a dollar is already factored in by the markets across most of the companies. So there is no much more upside, I tend to believe, unless because of short term volatility in the market that may come to you, because of which there is a you may get a kind of a alpha for your own portfolio by investing into oil based companies. Now crude based and crude falling down seems to be a very negative scenario for Cane India, and that is true if we look at Cane India only as a oil producer, but crude as a when we look at Cane India also as the fact that it also has a strong exploration portfolio, then crude prices falling down is not necessarily very bad. One of the few things that is missed out by most people is that oil production can be controlled at times, and if the prices are below what management would like, or they would kind of tend to cut down on their and how aggressive they are in developing an asset, or they would like to cut down how much production is happening, because the production also has to be economic and needs to meet their return requirement. So that kind of optionality that the companies have, especially exploration based companies, that tends to give a much more higher value because of the volatility in the crude price, not just because of crude price going south. So if you look at the fact that if the crude prices are likely to go south over the longer term, then that is really negative for exploration companies. But if the crude prices are going south, and but however long term is not necessarily south, long term is very undefined, uncertain, and which means it is going to create sort of volatility in crude prices, and companies tend to get benefited because of the volatility of the crude prices. So in Cane India it is a mixed bag. It gets effects and keeps on exploring in its South African block. That is the crude prices going south is positive for it, but on its Rajasthan block, if it does not get an extension, then that part is a bit of a negative. However, as far as valuation is concerned, at 280, I believe much of the worst case of the whatever is possible in Canada has already been factored into. The next question is by Mr. Prashant Kadam. Is cement cycle on upturn, which stocks can be bet on from now on 1 year for 1 year? Example, Shree Cement or ACC. Uh, uh, there is a good reasonable hypothesis to be made to expect that the cement cycle is on upturn, and that has been one big reason that cement companies have done really well over the last 8 to 9 months, especially post August of 2013. uh, Many of the companies, even ACC has moved during that time from 900 to 1400 1500 kind of scenario. uh, is Ambuja itself moved from 150 to about 230 kind of a level. Shri Cement moved from about 4,500 to now close to, I presume, closer to 9,000 now. Uh, the point I'm trying to make is that the cement cycle may be on the upcycle over now, but it may require certain two industries at least to start picking up. One industry been clearly been the real estate. I do not foresee that happening over the next 12 months for a simple reason that I foresee RBI to continue with its 8% kind of a repo level for next 12 months at least, with probable 50 basis point cut over the next 12 months, as such, if it sees a softening of inflation happening as such. On the other hand, uh, the second most important industry that may contribute to a cement cycle upcycle, cement industry upcycle would be clearly be infrastructure. If the infrastructure spend kicks up, I believe that there is a case for a cement cycle demand to start increasing. However, I believe markets have already factored that, they have already gone much more ahead of it. Wait for corrections to start happening in the cement cycle, because I believe infrastructure upspend will happen post and a Feb budget. You may see strong infrastructure upspend being declared by the finance minister uh, after his Feb budget, especially if he can meet his 4.1 and a target. One of the key things that I think most of the people missed out in the budget is the kind of guidance that the finance minister has given. clearly laying out path that India would like to move towards a much more benign level of fiscal deficit target of around 3% over the next 3 years. That, if it is achieved, would create a huge foundation for infrastructure in a push that can be made at multiple levels, both from center as well as the state. But that is still, I believe, about 18 months away for the demand to pick up, 12 months away for infrastructure projects to pick up. Around the time the budgets start picking up, that would be the time I think one should clearly go and look at the cement companies. As of now, I believe that much of the possibilities has already been factored into cement companies. There is no much upside because of the fact that the risk reward scenario has significantly deteriorated. For example, if the cement cycle does not really picks up, you can expect cement to come back from 7,500, 8,000 to back to its around 5,000 to 6,000 level. On the other hand, I do not expect much correction in Ambuja to happen, but ACC, I would not be surprised if it comes back to around 1,200 kind of levels once the market realizes that, and there's still time, or they are get disappointed that the infrastructure spend does not kicks in. On the other hand, one needs to be aware of the fact that over last 12 months, both the UPA government in its last 6 months as well as the NDA government over the it's for first and about four months. They have been they have been clearing lots of projects. So industrial activity may pick up, but one needs to see, just because what I have started observing is that even the project clearances have now not been are not so much of a constraint now, but the investment cycle is still not picking up, showing that the industry still needs to have a confidence that the GDP growth rate and demand will materialize from both the government sector as well as the retail sector for them to start kickstarting investment. The next question is by Mr. Ashish Kumar. Do you have any view on JSPL and Suzlon at current market price? JSPL, if it is available below my DP, I would be clearly be interested. One of the things that about thing I would like to point out to you for Jindal is we based on its 10-year performance, the key thing to look at it is that even though the growth has been extremely high for Jindal Steel, of late its value creation has been falling, and that has been very steep. The fall in the return on capital employed has been very steep. Even though, if you one way to look at the way its sales growth has happened, that has been very high. My point is that because of this reason and because of the kind of cash debt that it has, we have been very negative on JSPL. However, that in itself need not be a very bad reason not to invest into it. One corporate issue you need to be aware of is that this is definitely was very close to Congress. One of its sorry, its owner was an MP of in Rajya Sabha for Naveen Jindal. So Naveen Jindal in the Rajya Sabha from Congress. So it was very clearly aligned with Congress. Maybe a bit concerned on the too much of closeness to a political party. I would not worry about a backlash happening from the government, but the kind of competitive advantage of the negative kind that it may have tended to enjoy in the past, it might not. On the coal block front, I believe that once the auctions take place, it may increase a bit of its cost, but it would not hurt its long-term operations as such. However, given the recent kind of risk that has come over there, I will look for a much more higher level of safety in my value in my purchasing, and I would like to not take a huge exposure into Jindal Steel as a percentage of my portfolio, given the fact that as I stated in the start that in for the steel industry, I believe that the next 1 to 1.5 year would be very crucial to identify who are the kids and who are the big boys in this field over the next 18 months. And clearly people who have very stressed balance sheet are going to find this very hard to achieve. On the Suzlon, I believe unlike most of the companies in which who have seen their erosion in a shareholder value of up to 75 to 80% from their peak values, I believe among that Tulsi Tanti is one of the great guys who is trying to turn around his companies, who is very passionate about his business and who at least is a genuine person. He is not of a kind of a Vijay Malaya kind of a guy. However, on the other side, when if you look at business economics, then windmill is going to get a huge competition from solar as far as renewable energy goes, because the prices of solar are likely to reach grid parity by 2017-18, at least in the developed world, and that is going to be a big challenge for renewable energy companies like wind companies like Suzlon. On the other hand, windmills also require quite a lot of rare earth, and there has been decreased in a rare earth and availability in the market because of the decreased production coming up from China, which today has about 75% of global production over there, and that has significantly tended to increase the cost. And because of that, if you look at Suzlon, they are clearly just struggling to make the operating profit also. Until they cannot achieve that, the Suzlon's turnaround is clearly at risk. So I keep out a Suzlon on my radar always, because of the fact that the management I know is very good, but I would like to see its business economics also start showing a much more higher kind of a uptrend, and then I would like to invest into Suzlon. See, one of the key things you need to understand is that in a turnaround kind of a story, most people tend to run quite fast because they think that they'll miss it out. Our analysis shows that the key to a turnaround story is to understand that the turnaround has been clearly been sustainable level. Investing in a turnaround is like trusting a junkie, because you can never say when he will relapse back. Same way, it is not easy to say whether the company will relapse back to its old habits or to a bad economic performance. That is why you take a time, understand and know whether the sustainability has been reached. You may miss out on an bragging point of saying that you invested in Suzlon at $5, and you can increase your investment by 4 times. But understand, even at $5 you would have invested just 1 lakh rupees, assuming your portfolio is about say 1 CR, and it would have just given you 4% impact to your portfolio. Rather than that, the moment you know that Suzlon has become sustainable, even if you invest at $40, therein if you make an say 25 or 30% of your impact, 25 or 30% of your portfolio, and from there on, even if it doubles or triples, uh, the impact to your portfolio is going to be very high. So there's no case for being too early unless you have some insider information, as a not of a illegal kind I'm saying, but a legal kind. You know the employees, they are telling you some great things about the company. You know the bankers, they are telling you the great things about the company, and that has resulted you to realize that the sustainability has been achieved much more before the market has realized. Please go for it. But for Suzlon, be kind of careful about the kind of business economics is about a windmill, which as of now continues to be very crappy. The next question is by Mr. Manoj Kumar. His question is, when the re-rating of the Nifty 50 company script will be done? I presume I presume that that has already been done by all for all the companies except for those who are DCF. DCF as a methodology ensures that the valuation has to be changed much more less frequently, because most of the factors affecting the economics of the business have already been factored into. So it tends to be much more stable, and as far as an economics of the company go. The next question is by Mr. Sashi Kumar. His question is, there are very few buy calls now. Do you mean to say now it's time to sit and wait to get stock below MRP? Yeah, Shashi Kumar, that is what we exactly mean to say. We have been very cautious in giving out buy calls. Only in some cases wherein we saw that there was still a good risk reward scenario, we kept on giving buy calls. Even though now, if you look at one or two cases, we clearly lost out on certain significant things happening over there. For example, in Bajaj Finance, for example, in HCL Technologies and Dr. Reddy's, and because of that, you are seeing a huge jump happening in valuation because of new understanding that we are getting about these companies. In some cases, we wanted to be cautious because we wanted to see the competitive advantage play out. In Dr. Reddy's case, we wanted to see whether they will keep on continuing with a higher level of R&D spend or not. In HCL Tech, we wanted to see how the onslaught of TCS and now Infosys is also entering into IMS business would be able to impact HCL Technology a bit more. Now that we have more confidence in all of these three kind of companies, you have seen a huge jump in valuation. So we have given a buy call in this kind of few companies where we believe there is a reasonable basis of saying that there are certain aspect of business that has not been factored in by either by us or at some cases even by markets, and they may tend to give a much more higher disproportionate growth going forward than what market is factoring today. So therein we have given buy call. But on the other, overall I would tend to say is that be cautious in this market. Try and buy into companies only when you get a good risk reward scenario. Those are the companies that would do extremely well going forward. As of now, even if you stay on cash for about till market and correct, these are going to be good time to buy into the companies. But if the markets are not available at fair below their fair value, I would ask you to be cautious as such. Next question is by Mr. Vinay Keragodi. His question is, can we buy Sera, Astral and Mayur? While I do not know about Astral as such, I'll get back to you through an mail on this. For Sera and Mayur, both of them are clearly very good companies, quite a good return ratios. But the thing is, over the last 8 to 10 months, they have really reached overvaluation kind of case. I see this even in company like Asian Paints, kind of a company where these are companies which clearly very well run, they are clearly very well run. They have probably have very strong growth also may come in their top line as well as bottom line. But I think the markets may have already overdone that, and they may have already captured much of the possibilities that may exist over there. So Sera, Mayur, Symphony, Asiana, very good management, very well run companies, but clearly I think management may the share market may have already factored it. Wait for the correction happening, or you getting them at a decently good price before entering into them. I do not want you to wait for the say DP kind of scenario, but at least look for a fair valuation kind of a number, like say 25 p or 30 p kind of a number for say Sera kind of a company, or Symphony kind of a company, and then enter into the company. The next question is by Mr. Steven. His question is, which stock should we invest in within the allocation in terms to maximize returns? As of now, Steven, I would like you to sit on cash 100% if you have not made any investment. For a simple reason, I believe that when a market may go through a rough patch, I don't know if this is the current negativity that is running in the market is the patch that I am speaking about. I do believe that the market is clearly underestimating the kind of global risk that is there in this market. Second, market is also clearly underestimating the amount of effort that would be needed by the policy makers, both at the regulatory level, both at the political level, and at the industry level, to really kickstart an investment cycle and create a value for their shareholders. So be patient, wait for before making investing, keep following if we come up with some buy calls, but however get back to me after 3 months and I may have a much more better answer, because the valuations would give me much more better way of giving you strong companies wherein the return and risk profile would be very great. uh, the next question is by follow-up question is by Manoj Kumar. What would be the possible target price for Kane India for next 5 years? Manoj, I would like you to sort of move away from the kind of a target price. I would say that if you can invest at the price anywhere in between 250 to 280, rest assured you should expect somewhere close to 13.5 to 15% of a CAGR return each year happening over next 5 years. Anyway, it might not happen in a linear way. There may be some lopsidedness in it. It may happen that you may buy it at 280 and over 4-5 months later, Kane India may start be at 350 kind of level. So a significant jump about 20-25% already has been captured before 1 year is over. But you should expect that over an average you should get a 15% kind of a CAGR basis easily on Kane India if you can invest at the price of 250 to 280 kind of a level. Do not be too greedy in this also, and see to it that at the end of the day it is a commodity company with a strong asset base and a strong culture of exploration. However, because it is in a commodity space and in a space which which as a business operation also has a high level of risk. Do not increase beyond 10 percentage of your portfolio for investing in it. The next question is Baswaraj Kalupur. His question is he brought Maharashtra Seamless for 330. Can I hold to or shift to Kane or any other stock? I think you may continue to hold Maharashtra Seamless for one simple reason, that I presume the piping industry should start doing well over the next year once the power sector also started picking up pace. Yeah, if you have a relook at the news, just about 2 days back, and BHEL got a significantly big order of about 7,800 crores from Telangana Genco for putting up a power plant in Telangana. Now, it may be a one-off case, but I think it may mark a sign of recovery in power sector, a slow recovery which may pick up steam much more in the 2015, and that may be really be very good for piping companies also. I would not like you to move from say Maharashtra Seamless to Kane, because uh, in Kane again you will have to wait for at least 4 to 5 years, because I cannot exactly advise you for Kane whether the return will happen 15 percentage each year or a much more lopsided return towards second or third year as such. I would like you to stay invested in Maharashtra Seamless for now. The follow-up question by Aditya Save: in current market levels, which companies categories are still available at low valuations and have big upside for them the next 12 to 16 months? Uh, a bit of a tough question, because unless market or tends to correct or data tends to improve, from our coverage I would be bit skeptical if there would be any big names that would start giving significant returns. One may clearly would have to start looking at a small cap, mid cap, and to some extent a micro cap. However, when you start looking at these kind of companies, please pay attention to the fact that they have increased significantly by 5 to 10 times over the last 8 to 12 months. A significant kind of a upside may already be have captured into, and in a bull run at many times in small cap and mid cap, I have seen brokers tend to hype up a company by giving a significant upside initially, and then when it starts getting attracting retail investors, and they start to start dumping this share price. So it tends to happen a lot in bull run, not so much in the bear run. So I would like you to be cautious while investing into small cap, mid cap. Second, look for companies that are doing big game changing things in certain niche sectors. Those are the places where I would expect things to move really very well. So some companies like Cient is still been thought about like an IT company, but if you were to just look at very basic glance, it does not does anything close to IT. It is more an engine. uh, can someone please help me and know whether you guys can still hear me? I suspect that you may have lost voice. um, yeah, thanks. Thank you very much. My point is, you can look at company like Cient. I don't know whether it will do very well, but I do think that it is a company that has not been so well understood by many of the investors. They still think of it like an IT company, a mid cap and IT company, because of the kind of its profit margin it is and the kind of behavior it has. But it is mostly into energy engineering services, which I believe could be the next big thing in the India. I believe that much of the IT business is now becoming commoditized, except for in few places. The typical application and development business is now becoming a commoditized business. So you can look at such companies like Cient. It is not a small cap company by any measure, but I think there is a good chance for re-rating, and there is a good chance for an upside, that it will have a strong runway over the next 10 years on which to ride itself. The next question is by Mr. Manohar Bambani. Jindal Steel and Power is below DP. Why buy signal generated? I don't think we have generated buy signal for Jindal Steel and Power. I presume you may be saying why not it has been generated. So one of the reason why it has not been generated is because of its past performance, we do not see that it can capture any value for shareholders. One of the big reasons that it did extremely well over the last 10 years was clearly its proximity to the establishment at that time. But the kind of return ratios that we are seeing over of late in Jindal Steel and Power is significantly scary for us, and we believe that we need to be worried on the kind of balance sheet strength that it may build into the company. And going forward, we may be actually and see valuation also tend to come down, though I'm running much more ahead of myself. But the clear point being that because its 10-year excess rate, we as a rule, as a filter for us, so that we do not take a huge amount of risk on ourselves, we do not give a buy calls on red companies only when we believe that these red companies are now moving towards an turnaround. Then we tend to be a bit cautious and then suggest for investment, but yet again a very small percentage of portfolio investment only. The next question is by Elumalai. His question is about sir, tell me about NMDC, SESA, and metal sector as such. I've clearly laid out for steel and aluminum. I believe SESA and NMDC. If China slowdown keeps on continuing, you should see an iron ore prices hovering around $90 as such. A bit not very good for an NMDC and SESA as such, but given the fact that NMDC has very strong balance sheet and SESA, once it can kickstart its operations in Karnataka and Goa, uh, given once Supreme Court gives it a clearance, uh, then it has a very low cost asset base, so it can start generating strong cash flow. Most of the people don't realize that SESA is also exploring. SESA also has developing a strong iron ore asset in of Southern Africa. Uh, that is not realized by many, and the kind of reserves that they have over there, I believe that their international operations over next 5 years can significantly be much better in the iron ore level than their Indian operations. On the other hand, as I stated, that one of the key negatives for SESA Sterlite is that they have lots of debt on their balance sheet, but on the positive side they have lots of cash, but this cash resides in their step down subsidiaries, wherein for some reason they do not have very high level of control. In Kane India, it is significantly because it tends to be behave as a separate company from an SESA Sterlite. As such, and which has been not having a 85-90% is kind of a control. It cannot significantly divert that cash generated to its parent company. Same way with Hindustan Zinc, with a significant percentage stake with government of India, it has consistently failed in using those cash even for an investment outside in a zinc properties as such. So they need to work on that. Contingent to they clearing, say, at least Hindustan Zinc and a buyback from government and delisting it probably, and aluminum doing a bit well, SESA can actually be a very good investment as such, but it is contingent to these two things happening. On the metal sector side, China, as I've stated again, that a slowdown in China is clearly a big risk. Most people are not realizing it, because China consumes nearly 50% of most of the metals. So metal sector is likely to not do well as far as earnings are going to do. Second, as far as share price is going to do. However, if in this time, if you can catch hold of and companies with strong balance sheet, or at least companies with strong asset base. Strong asset base means companies whose asset cost of running those assets is going to be very low, or cost of production per ton is very low, or cost of production per barrel is very low. Those are the kind of companies I would like you to focus on. Those companies would do extremely well over the long term, because this weak period of over next 2 to 3 years, largely driven by a slowdown, bit of a slowdown in the Chinese sector, so in the Chinese economy, I believe if India starts growing at 8.5-9% of rate post 2019, then we can see a scenario in which India would also start ramping up its metal consumption, and that would be extremely positive for these kind of companies. The next question is by Shirish Shah. His question is: shall we come out of sale if outlook is not good for next 1 year? Shirish, outlook is not good for sale for next 1 year. On the other hand, if the infrastructure pickup kick starts, sale would be one of the few key beneficiaries of that. So the way I would like you to look at it is, if you have bought at a significantly very low price, you need not be worried about it. You may stay invested in it. But if the pricing is at which you have bought is not right, then you may think of saving a capital and moving out for at least 6 months, not 1 year, at least 6-7 months. If you get a sale anytime in this 6 months, again at say somewhere close to 50 to 60 rupees, those would be the price point I would be interested in it. However, even at 50 to 60 rupees, be aware that sale can over the short term move down to as low as 35 bucks as such, given the fact that sales margins would depress a lot over very small single digit numbers if steel prices correct as a result of imports from China. The next question is by Shirish Shah. Again, his question is: do you feel BHL is still worth holding? I believe BHL is still worth holding. Uh, if you believe in India story as such, I think you should believe in BHL story as such also. In spite of most of the complaints that I hear from the power analysts across India who say that it is not necessary that BHL would be the key beneficiary of revival in power, I have very simple pushback to them as such, because and that is that can can these multinational competitors from say China Light Power to Siemens to ABB and Alstom, can they or Mitsubishi in partnership with L&T, can they match the price point of BHL? And in most cases, I have not seen that happening. And because of this reason, I don't will accept that hypothesis that BHL will not be the primary beneficiary of revival in power. Power is the significant constraint to Indian growth. The kind of growth that we expect of 6.5-7% with by 2017 or 8.5-9% kind of a rate post 2019, it cannot happen if the power investments do not start flowing in, and BHL would remain a key. The only weak point in the BHL story is how does the solar do? Because if solar tends to achieve grid parity, it will not take huge time for a solar to become a big power segment in on its own, uh, and that would be the key. In that, it's still 5 to 6 years away, I believe, for it to happen, but that would be a key long-term risk. If solar achieves grid parity, it would put clearly a death and a nail on its coffins of dirty power plants like coal. The next question is by Anil D'Souza. His question is: which sector will do well in next 6 months period? I hope I've answered it in the course of the webinar. Uh, about Hindalco, I have told you my confusion with aluminum. I would request you to give me a period of 3 months because I would like to see how aluminum does. However, one of the key problems that I have with uh, one of the key problems that I have uh, one of the key problems that I have with companies like Hindalco is clearly uh, kind of returns it has generated for its shareholders. Now, Hindalco is a kind of a company that I believe one should avoid irrespective of any temptation unless and until I get it at a very low price, because its management has a consistent tendency over long term of generating pathetically low returns for its shareholders. It's seen in the business level of details also, where like return on capital employed. You may see it in even the EPS. It is one of the few great companies that has simply decreased its earning because of a much more larger base of shareholders. Even if I look at on a profit basis, the profit basis growth has not been very great, something to speak about. That the debt continues to be at a humongously high level. Its hope of its Mahan and its other greenfield projects and helping it and give it a growth would also only result in a probably a top line growth, might not end up giving too much of a long term growth. And there is one single thing that I would like you to focus on. And I do not say that enough. I tell sometimes to my analysts also that there is a price for everything, even price for some bad companies. If you can get them at a highly discounted price, you may still look at it. But then sometimes you come across companies like Hindalco who do not know, who consistently make bad capital allocation decisions. And I would like you to focus on a single chart. This is a single chart since 2005. Let's take away the split part away. So since 2005, shareholders of Hindalco have not got a single penny as return. So I would like you to keep this chart in mind before investing. This may come out true for many companies, but there are, if those companies have been very good on the business side, you would see that the last few months or going forward things would be very different for them. But I highly suspect this would be true for a company like Hindalco, for a simple reason that consistently Hindalco has achieved one great thing, that is of consistently deploying its cash flows in a pathetically low return projects that just waste investor money. It is run more like a family fiefdom rather than creating any value for its shareholders. Investors may do better to stay away from such kind of crappy companies. uh, the next question is by ITC. If ITC is in your portfolio, it's an evergreen company. Till it does not misses out on its growth story, as well as its value creation story. I think one can keep ITC as a good anchor to their portfolio. And if you can get ITC ever at kind of PE of close to 25, just go bollocks and buy as much as you can buy over for ITC. On the other hand, uh, we believe that over the next 6 to 12 months, its FMCG business, other than the cigarette business, would start turning around an operating profit. That would be a significant change for ITC and may give a much more greater flip to its profitability than it has been enjoying for quite some time now, as of now. I think you should be invested in ITC. Uh, the next question is by Baswaraj Kaurpur. Any online retail company like Snapdeal and Flipkart? Baswaraj Kaurpur, any online company like Snapdeal or Flipkart, I'm clearly not interested ever in investing, for a simple reason that unless and until they can show me cash, I am not interested into buying into them. These are the companies that are built for valuation, to say so. These are not the companies to create value for the shareholders or generate any cash flow ever. If you would get to see a Flipkart and a balance sheet over the last 3 4 years, then you would simply be very scared to invest in it. I believe E&Y is its auditor. You may like to read what Hindu Business Line had a news news item, has a headline news item on Flipkart's balance sheet about two days back. It clearly stated, the auditor himself clearly stated that there is a significant problem of thinking of Flipkart as a going concern, meaning even the auditor was worried whether Flipkart can continue as a company as such. Flipkart can exist as a company only till the time that venture capital funds can keep on financing its billion-dollar sales. The only people who make money on billion-dollar sales are either the customers or its marketplace participants. The last question is by Mr. Manoj Kumar. His question is, do you have any multi-bagger stock idea in the current market situation? Manoj Kumar, at the kind of current valuations that the market are, I would not go on the basis of multi-bagger as such. I would like you to think of only companies wherein the risk reward scenario is very high, because as of now the valuations across the board have increased a lot, and there is not a good opportunity that gives me the kind of expectation of a strong business opportunity possibility, but discounts for the risk that may happen because of that. So no multi-bagger opportunities as of now in the current market. At least I don't have that. I think would be any kind of success story, and of which such a conviction that I can invest a significant part of my portfolio in it. And I'm not interested in a 1% kind of a multi-bagger story, as in a multi-bagger story in which I just end up investing 1%, because I don't see it generating any much value at a portfolio level, even though it may give me a bragging point. As of now, I do not have any multi-bagger story as such. I am not looking at a multi-bagger story as such, for a simple reason: valuations are very expensive, and I want to have risk rewards uh, sufficient enough for me to achieve that multi-bagger kind of a investment. Thank you, and happy Diwali to all the your members. Just one small announcement I would like to make is, we have been getting a feedback from many of our investors, that many of our clients, that now we should have something on a small cap and mid cap and a product also. We would be launching a small cap mid cap product close to 1st of December. You will start getting now the kind, this would be a bit different kind of product, because given the risk in small cap and mid cap, we are restructuring how we are going to give you the calls also for this kind of small cap mid cap companies. So that would be launched by close to first week of December as such. You should start getting our mailers for that over the next 2 months. Again, we are looking for same kind of a companies. We are looking for companies with niche, with ability to create a long term value for their shareholders, or maybe on a case for a strong sustainable turnaround basis. But they are certainly very small, or either on a, because they are serving very small niche, but are creating strong value for their investors. So it's to keep on looking for those companies only. So not all small cap mid cap would be a part of coverage. A select curated way of 25 to 30 companies would be part of that coverage. With this, I would like to bring our current subscriber webinar to a close. Do send us your feedback, and if you have any further queries, do drop your query question on the mail, and I'll get back to you.